Morningstar is a US-based research firm that publishes stock and mutual fund data. The firm is widely known for its mutual fund star rating system. The system rates mutual funds according to a 5-star system, with 5 stars indicating superior performance and 1 star indicating poor performance for the time period. Although Morningstar warns against choosing funds solely on its star rating, many investors do just that in their quest for higher returns. But they should not expect their narrowly focused approach to produce reliable results over time. This slide documents the challenge of picking a future winner based on its Morningstar rating. The top chart displays all US-based mutual funds, 14,822 funds, sorted by their Morningstar rating at the end of 2007. The bottom chart plots performance of these funds over the subsequent 5-year period based on each fund's percentile return rank in its respective peer category. A low percentile indicates high relative performance. So if funds with high star ratings could repeat their top relative performance in the future, the data in the bottom chart would demonstrate this, with high star rated funds delivering high relative returns and lower star rated funds showing lower relative performance. The chart would display the fund performance in stair-step fashion, with a large concentration of 5-star funds in the higher percentile range, such as the top 20%, and most lower rated funds concentrated in the bottom percentiles. When you look at the actual data, it tells a much different story. In the bottom chart, each star rating displays broadly dispersed relative 5-year performance, confirming that a fund's past rating does not indicate future returns. Note also that nearly 1/3 of funds across all star ratings failed to survive the subsequent 5-year period, as indicated by the dead funds sort, which is a total of 4,269 funds. These results are consistent with fund performance research, which finds little evidence of persistent outperformance based on star ratings. Some investors look to financial metrics to anticipate future mutual fund winners. But are metrics any better at predicting performance than Morningstar's star rating system? Let's consider the Sharpe ratio, a popular metric that measures an asset's return relative to its volatility. In this example, the ratio is calculated by first subtracting the risk-free rate from the return of the fund, then dividing by the fund's standard deviation. A positive ratio indicates better historical risk-adjusted performance. This slide sorts the US fund universe, over 12,000 funds, by 5-year Sharpe ratio, the top chart, and shows the fund's subsequent 5-year annualized returns with each fund positioned according to its prior period sort, the bottom chart. If a fund's historical Sharpe ratio has predictive power, one would expect to see higher ratio funds producing higher relative returns in the subsequent period. Clearly, this is not the case. The broad dispersion of 5-year returns shows no statistical difference between high and low ratio funds. So, funds with high Sharpe ratios have no better chance than low ratio funds of delivering exceptional performance in the future. The futility of speculation is good news for the investor. It means that prices for public securities are fair. Markets work because human capital creates wealth by continually bettering our standard of living. It is the most valuable asset in existence. When you reject the costly speculation and guesswork present in active management, investing becomes a matter of deciding how much to allocate to small, large, value, and growth stocks in markets around the world, and how much term and credit exposure to target in fixed income.